Good morning, traders. Today is January 21st. Yes, I have a little hoarse in my throat. Sound a little rough today, but I'm actually okay. Last week was a very interesting week, and I want to focus everyone on the fact that we are moving into the apex of a broad flag formation that is setting up in the U.S. markets after this deep bottom right here. You can see this deep low that I've drawn. It's actually quite interesting. If we take a look at this, I had predicted a deeper base level, potentially setting up in a wave 4 correction, which we saw coming down. I'm going to try to change this color to match the other color, which is kind of that color. Make it a little thicker and get rid of the price distance. And you can see here we have this apex formation here. Wrong one. Try to make this as thick as possible. Okay, so we will get rid of this. Wish my mouse was cooperating. And what I want you to focus on again is this broad apexing formation from this level here, coming off of this low up to this level, coming across these highs. Now what we have to focus on, ladies and gentlemen, is the construct of this move downward. I've gone through this many times in the videos about how these constructs are nearly perfect Fibonacci constructs. We're moving into this apex formation right over here, and the way I'm counting this is from this peak we have essentially an A, B, C, D, E formation. This E formation is very interesting in the sense that it extended just below the previous lows, and it should be less than the copy. So again, this was a 825 point down move. Oops. And what I want you to focus on is that this was a bigger down move. So what we have, ladies and gentlemen, is in reality, it's a deeper pattern. You can see here we have an A, B, C going down to here. Then we have this deep low. We pulled back up, pulled back down. So there's our A, B, C up to here. A, B, C down to here. A, B, C up to here. A, B, C, D, E down to here. And that creates our 1, 2, 3, 4, 5 pattern, ending potentially wave 4 to the downside. Now we've moved into this apexing pattern where we've struggled across this high many times. And I believe we're going to see some extended volatility over here. I drawn these lines last week, and I will get rid of them because I want you to focus on where we're at with this move. Where we're at with this move is we are likely going to see some consolidation in this range over the next week or two as earnings continue to play out, and then attempt to melt back upwards. I'm guessing that the 4157 level on the S&P or the ES, which is what I'm looking at right here, is going to become a very strong resistance area for the market over the next couple of weeks. So theoretically, we're going to see some resistance in here, move up to 4150, and then eventually move up into this area, 4500, and stall in this area before the end of the year. That's what I believe is likely going to happen here. There's a lot of people that are, warning of the debt crisis and war and what have you. I need you to understand that the central bank and the Fed has greased the wheel quite extensively with the amount of money in the markets. There is still quite a bit of growth in the economy. We're seeing moderately strong earnings. I was watching CNBC yesterday, and Bob Pisani stated that about 69% of companies are coming out with better than expected earnings. That gives us about 31% are seeing reduced earnings. So this is what happens during a contraction period. And this is very, very similar to 2003, 2004, after the dot-com bubble burst. It's kind of a revaluation process. So I'm still under the belief that we've reached our bottom, that these lines do not matter. Let me get rid of them. At this point, they are potential outcome, which is highly unlikely right now. But the reality is we've seen our downward move to this base. We've seen our upward cycle trend here. We've consolidated into this range. We've set up a higher low. At this point, ladies and gentlemen, we need to watch this apex. We are literally 1, 2, 3 weeks away from an apex, which will move us into an upward channel, I believe. And we need to watch this downward support level. You can see I've drawn all of this support around 3,600, 3,400, 3,500. We've got numerous support levels down here. And the reality is current support should be somewhere around 3,840 on the ES. As I expect the markets to digest into an upward channel or resolve into an upward channel and attempt to move back up to this 4,400 level. Okay, so let's come back over here. Let's look at the accumulation phase index. This is the S&P 500, basing and bottoming. This is a monthly chart. You can see here that we've got the accumulation phase index is moving downward as I expected. This is ideally what we want to see here. We want to see the accumulation phase index drift downward towards this green line here as the market finds some strength. Remember, we're not going to skyrocket back out of this. This is going to be a slow, consolidated upward revision or reversion. And I expect that we're going to be back up into this, what would be here, this 240 level, back up into these highs by the end of this year. So we're really looking at about a, maybe 15-20% upward move in the markets throughout this year as the market digests what's taking place. Could be a very lackluster year. I mean, we're seeing volatility start to weaken. VIX is headed downward, but I do believe we're going to resolve to the upside here. Next, we have the weekly fear index. Weekly fear index has dropped down 6.32. This is great. We need to see this move downward as the SPY, this is the SPY, moves upward. The market sentiment index, very close to the middle level here, this dark brown level, building support off of this deep, deep low. You can see this extreme selling took place back in October, and since then we've been kind of holding up. It's very similar to what happened over here, kind of building a base, moving back upward, and then eventually we'll build enough momentum to move back to the upside. For example, back over here where we see some real accumulation, and this is kind of the same scenario. So imagine this is our deep low here. We're coming back up. We're trying to build a solid base. We may get some rotation. You see how the sentiment moved down? Markets barely moved. You see how the rotation here, we saw some big downward moves. Markets barely moved. We're going to probably see the same type of thing over here. Some sideways, upward momentum, sideways trending, and then eventually by the end of 2023 into 2024, move upward strongly. U.S. Valuation Trend Index. This is a custom index showing you what's going on with the markets. This is the deep low in 2018. This was the COVID collapse back over here. You can see we've had a very strong devaluation cycle from essentially middle of 2020. And this is really kind of important for you to understand. This valuation trend index shows us that we've seen, just like from this point, from 2016-17, we've seen, this is actually 2016, a very strong downward cycle trend followed by a really strong appreciation trend. We're now in this end of phase here, like I've been talking about. We're seeing a little bit of support here. If we move into a new upward cycle trend here, which I believe is going to take place, This means that the markets will build a base, will find support, and will attempt to move forward higher near the end of 2023 into 2024, 25, 26, and then possibly peak around 27, 28, 29. So very solid basing and bottoming formation here. A lot of people are saying, you know, oh, the world's going to collapse. I hear that all the time. And you know what? I think we're in a different set of circumstances here. I think we've devalued. I think the money supply is working its way through the globe. It's doing what it's supposed to be doing, and I think traders are going to be very surprised that we're going to have potentially a 3 to 5 year rally phase out of this. U.S. leading market index is stalling up near this upper level. As I mentioned to you, this is fairly high. We could see some consolidation here in the next week or two, maybe rolling a little lower to test the lower bounds of the channel of the apex. But we're moving nice and strongly to the upside. We've seen this roll upward here in stochastics, roll upward with RSI. We could stay in this range for another 3, 4, 5 weeks before actually moving, seeing any big movement to the upside. This is really an expansion bubble phase. The leading index doesn't get outside of this range very often. Remember, this was the 2019 rally. This is COVID. This is the basing and bottoming that took place. You can see we got up into this level, stalled back out over here, and then moved forward. This was the election, the presidential elections, and then we moved into this point. Now, why did we rally so strongly here? This was really an anomaly with the Fed pumping money into the economy after COVID and trying to spark the real growth. Getting up into these upper channels up above this red line, this shows a real bubble setup building. I don't think we're going to get there this time. Maybe towards the end of 2023, but I think we're going to stay in this upward channel, possibly bouncing up, coming back down, bouncing up, coming back down, bouncing up, coming back down, which is still moderately bullish. Again, the markets would probably melt up 15% or so as this continues to stay in this upward channel. Ideally, ladies and gentlemen, we need to stay above this kind of middle upper channel. This is the middle of the channel down here. This would be an extreme low, the way I've drawn it. We need to stay up in this upper channel area, basically between this upper red area and this green area here. This would continue to be melt up trending in an upward bias. Okay, the volume ratio chart got a little bit stronger last week. We're seeing quite a bit of capitulation in the market. I think this is really going to resolve again to the upside. We're seeing a lot of accumulation here. I'd like to see a nice big spike above 758 with a big breakout. May come in the next week or two, but we're seeing some real accumulation take place right now. The metals trend index. Metals are, as I mentioned to you many weeks ago, many months ago, in a very unique scenario. I believe that metals have now reached a period where a pullback is possibly likely. So now understand that, there's going to be a lot of talk about metals, a lot of talk about this potential breakout trend. We're very, very close to new all-time highs. I believe we've gotten this strong rally. I believe it would not be uncommon to see a moderate pullback over the next couple of weeks in gold and silver, maybe a bit of a stalling, and before we get the next phase higher. Remember, this typically has moved up, do the math again real quick, about 4,000, 4,500 points with each wave. So from this level here, roughly just under 10,000, this means that we would be up in the 14,200, 14,500 target area for another big massive wave. But you can see here that we've come from basically 9,700 to 12,400 right over here. That's approximately, doing the math real quick, about 2,700 points on this custom metals trend index. We have about another 2,000 points to go to the upside, but I believe we're going to see it actually stall. So you can see here from this low, we moved up about 2,500 points, stalled out, and then rallied. I don't think we're going to see this kind of a stall. This was middle 2021. I think we're going to see more something like, and again, this is COVID. I don't think we're going to see anything like COVID, but I think we're going to see a bit of a stall, 2 or 3 or 4 or 5 weeks maybe of a stall in metals, and then a real big rally phase to the upside, targeting that 14,500, 14,600. This will probably come in the second half, near the second half of 2023 this year. Okay, the rotational modeling system has not changed. We're still in the same mode as we were before, and this is really important to understand. The rotational modeling system is designed to protect and secure your broad thinking of the markets. So we are still weekly bullish on the SPY, daily bearish. That nets us into a net 50% short position, 50% cash position. We are up about 1% overall since the last trade. We have been in a very solid protected position throughout all of 2022 and into 2023. This could change. We're getting some signals on the daily that we might get into some sort of a popping bullish trend, but I don't think it's going to do anything for the next 2 or 3 weeks. Probably more so into February, March, we might get a nice upward trigger, and that may change us into a 100% bullish position. But right now, we are staying safely allocated. The big news here is that gold on a weekly basis has flipped into a bullish trend. A couple months back, almost everything on here was bearish. Now we've seen quite a bit of things move to the bullish side. We've seen gold, silver move, the Dow Jones has moved, the mid caps have moved, the ES E-mini futures weekly and the SPY have stayed bullish. Consumer staples have moved into bullish. Crude oil and bonds have stayed bearish. NASDAQ is still struggling to get out of its own way, and it looks like it's basing bottoming. It could be a very good reversion trade. I've talked to you about that. But we're staying 20% stocks, 55% cash, 25% metals, which is our hedge position, which is actually working out extremely well right now. And as an alternate allocation, we have 20% stocks, 80% cash. This will give, in other words, this holding of stocks and cash is designed to protect us against risk right now. Because the rotational modeling system is not showing any united trend between daily and weekly, we're protected in cash, trading only a small amount of our money, and that gives us the ability to preserve capital through this consolidation period where others are losing 15, 16, 20%. The reality is the rotational modeling system has done extremely well this year and last year, and we are holding this position until we get a clear, actionable, broad market strategy trigger to move forward. And you can see here the rotational modeling system is very close to all-time highs. It's moving quite a bit stronger to the upside compared to the S&P. You can see here the historical quarterly results, absolutely fantastic. When you see the results that you're going to see from larger firms showing minus 20, 30, 40% drawdowns, take a look at this quarterly result. We had a little bit of a blip here in the early portion of the year and then climb back. The end of the year, we ended last year with a minus 0.60 drawdown, which is very nominal, and we're looking forward to starting out this year quite well. Now remember, we will hold these positions until we get some new trigger that generates any type of a rotational trigger. So in other words, if you have your retirement money in an account, this is how essentially you would want to have it set up. With regards to your trading capital, you would want your trading capital set up like this. So think of it as two separate pools of money. One is your IRA or your 401k or your retirement account. That is this setup. You would be 50% bearish, 50% cash, and waiting for a new trigger. With your trading account, which would be something that you would be actively trying to trade, you would be 20% stocks, allowing you to trade 20% of that capital, 55% cash, 25% metals, or 20% into trading stocks and 80% cash, waiting for this to move into a more solid trending phase, which gives us the opportunity to trade. It's very difficult to trade in a consolidated market, and we're going to take a look at that here. Okay, so the valuation index weekly chart is starting to show some strength. We're basing and bottoming. We've got a new high, new low over here. We're seeing some strength here. The next move, if I am correct, will be to the upside. It'll be back up into the, say, 61, 62, 63 area, maybe. And I gotta just preface this because we need to be aware that 62, 63, 64 is not stupendous given this in the past here, but this was a bubble. So understand, this was unprecedented price anomaly. If we can get up in the 62, 63, 64, we're in a solid melt up. And that's what I believe we're actually talking about here. Everybody's been trying to short the market for the past, well, since the October lows. Everybody keeps thinking the market's going to break to the downside, and it's been up almost 13, 14% since the October 2022 lows. And I think it's going to melt up another 10, 11, 12% or more before the end of this year, possibly up into the 4,400, 4,500 level on the ES. And lastly, I think we have the volatility index chart. I had been warning about this. I count this as a wave 5. I'll show you. This is the COVID low up to the September, October peak in 2021. Now we have this breakdown where I count it as 1, 2, 3. I can do that again. 1, 2, 3, 4, 5. Nope, I'm going to do it again. 1, 2, 3, 4. How am I doing this wrong? 1, 2, 3, 4. Yeah, I'm doing it the opposite direction. All right, so we've got to come up from this point here down to this point, which establishes our base, and we have to count it this way. 1, 2, 3, 4, 5 to the upside. Theoretically, if I count to the downside, this would be 1, 2, 3, 4, 5. And this represents a failure to move any further downward. So this represents a failure to establish a extended downward trend. And based on this pattern here, we have 1, 2, 3, 4, 5 to the upside. We have broken to the upside here. We have broken to a new channel. And that's why, again, I believe we're looking at very strong upward confirmation to the upside. I believe this extended deep low, which is right here, September, October 2022, this represents a failure for the market to attempt to move downward. Now, we could be in a corrective wave here, watching the market roll potentially back lower on some crisis or catalyst event. But I believe this substantiates the move to the downside, ends the wave 4 correction, potentially begins a wave 5 rally, and we will see what happens. If I'm wrong, of course, I'll let you know. We will see on the weekly charts, we'll see on the daily charts, we'll see through my indicators that the market has moved back into a weaker price channel. But right now, it looks like wave 4 is ended, wave 5 is beginning, and as I mentioned to you last week, this looks like a very strong upward price trend as we move forward. Okay, so what we're doing here is the TTScanner updates. I've gone through enough data to get you up to par. Remember, we're not actively trying to seek out big positions. We're actively looking at the market as a consolidated volatile phase, price phase. And this means that we need to look at these triggers as moderately short-term, moderately consolidated, and very flat right now. In other words, there should be very little opportunity for real gains to swing trade at the moment, simply because the markets, all of the markets, are struggling right now to move into some new trend. You can see we've got a flat trigger in QLD from last week's bearish trigger. We've got a flat trigger in clean energy, flat trigger in innovation, ARKK, ARKQ flat, and HAIL flat. We have these long triggers here that have been for 50, 40, 50 weeks. And we have a new trigger here in oil services, OIH, brand new trigger, which is a long trigger off 2.52%. So this is a potential new swing trade here. We have a couple of short swing trades here. Some of them are already 35 weeks old. This one in hack is bearish. It's 2 weeks old. It's up 0.27%. No targets hit. Remember to use the thrusting mechanism and the profit factor and win rate when you're looking at these. So hypothetically, with this OIH new trigger, the thrusting is 2191 in moderate blue. That's a pretty good confirmation that the trend is bullish, market is up, we're seeing some upward activity. We have a win rate of 2.25, which is very big. You can see it's one of the bigger numbers over here in this column. And we have a profit factor of 0.86, almost 0.90. That's actually pretty good in this regard compared to, hypothetically, this trigger. We have it's a short trigger, minus 3.48 in purple for thrusting, telling us that the market is not moving aggressively downward. It is moving moderately downward. We have a profit factor of 0.52, meaning basically 50-50 win rate or chance of profits. And then we have a win rate of 1.33, much smaller than this 2.25, almost half the size. So this one gives us an opportunity here, but because the profit factor is smaller and the win rate is smaller, this should actually be trading a very small position compared to this one, maybe at 60-70% allocation, whereas this one hypothetically would be 20-30% allocation. And these numbers change every week. The win rate and profit factor does not, depending on when it gets in and out of trades, but long and short of it, the thrusting mechanism does. So you can see here thrusting is back to purple here. This was a short trigger. It's positive. Most of these have gone positive. This is positive red, meaning that it is still indicating a downward trend, but it's sharply moved higher. That's why we're out of these trades. So now let's take a look at the next hot list, which is the core invert hot list. We have one new trigger here in ERY. It is a short trigger. Let's take a look at the thrusting. Is minus 2147, 0.86, and 2.13. This would probably be about a 50, 60, 70% allocation in my mind because of the downward thrusting and win rate here. We have a new trigger down here in JDST. Gold miners, new trigger 0.26 and 7.5. Very weak profit factoring and win ratio. This should probably be no more than a 10 or 20, maybe max 25% position, simply because we have downward thrusting. We're up 1.92%, but we don't have a huge win rate and profit factor on this one. And then we have a short trigger here in Yang, 1 week old, moderately, again, pretty strong negative number. That's a very big number, but we're in purple trending, which means moderate downside. We have a decent profit factor and a decent win rate. This would probably be 40 or 50 or 60%, maybe a little bit more. Now remember, each of these should be considered your trade slots. I've explained this to you many times, but hypothetically you've got $100,000 in your trading account. You may have $1 million over in your RIA or IRA or 401k. So remember, in reality, we have this allocation for your trading account, meaning you should have 20% into trading stocks. So we break that 20% into actual trading slots. So if you had $100,000 in your trading account, and my recommendation was 20% into stocks, 80% into cash, that would mean you'd take 20 grand of your 100 grand, allocate that for trading, and you'd break that into 10 or 20 trading slots. So that means each trading slot would be about $1,000 or $2,000 each. So understand that when I'm telling you that this is a moderately strong trigger, trading 50 or 60% of allocation, maybe 70%, that means 60 or 70% of one trading slot. of either $1,000 or $2,000. This is a moderately strong allocation. This would probably be 60-70% of your, maybe a little more, and that is again of your $1,000 or $2,000 trading slot. This is a weaker trigger, telling you that we have a lower win rate and a lower profit factor. So this would be maybe 20-25% of your trading slot. That means that it would only be 20-25% of your $1,000 or $2,000 trading slot. You handle these trades in the trading slot mechanism. That's what I'm trying to teach you. So in reality, on this page, you'd have maybe $2,600, $2,300 maybe invested in 3 trading slots out of your $20,000, okay, allocated for trading. Back on this page, we have one new trigger here, which is moderately strong, 60-70% allocation. There's your third or your fourth trigger. Now you've got 4 trading slots used, and hypothetically, you could try to catch this one, which is, again, moderately flat, kind of okay, so this would be 40 or 50%. There's your 5th trading slot, using maybe $600 to $1,000 into that. This one, because it's a little stronger, maybe somewhere between $800 and $1,600 into this. And then we go to the next hot list, which is the TTScanner main list. And we have no new triggers here, just these long ones here and these flat triggers here. So in reality, of your $20,000, you've got maybe $3,000 or $4,000 allocated, maybe a little more, $5,000 allocated into trades. You're sitting on $15,000 that are in open trading slots, not doing anything, and then you've got the remaining $80,000 sitting in cash and potentially metals. That's how this is all designed to work for you, okay? And then we'll go to the last one, which is the value list. We have no new triggers on the value list. We have a couple of triggers here. We have one flat trigger here from last week in Apple. A couple of triggers that are 4 weeks old. They're 3.65 and 6.76 profit. These potentially could be your 6th and 7th trading slots. This has already hit both targets. You can see that it is weaker. It's a long trigger. This is in Smuckers. We've seen it pull back. And you can see the profit factor of 0.49 and 1.0 and 0.88 and 1.78. Obviously, the 4.9 and 1.0 is a bit weaker. That would put me at probably 30, 40, 50% allocation. And the 8.8 and 1.78 is a bit stronger. That would put me at maybe 60, 70% allocation. We want to use these to gauge how we address market trends, but we're not getting any flood of signals. The markets are just simply not trending. And that, again, back over here, we are consolidating. We have 3, 4, 5 weeks more of potential consolidation before we reach this apex around February 6th, and I believe that will start a new melt up to the upside. Okay, guys, follow my research. I'm getting ready to change things on the website. I hope you guys are really paying attention to what's going on here and understand how all of my allocation levels work. Remember, it's basically 2 accounts. You have your retirement account and you have your trading account. You should think of your money in that way. How much money do you put away into retirement, which is long term? How do you manage that? And then how do you protect and manage your trading account so that you can survive to trade another day? The markets are going to move into a more opportunistic mode over the next 2 or 3 or 4 months, in my opinion. But right now, and through all of this cycle, from basically back over here in August, September 2021, all the way through here, we've been actively protected against downside risk and upside volatility, and we will continue to do so until my systems tell us that the opportunity is there for us to move forward and become more aggressive. Okay, guys, talk to you soon.